Hey everyone, this is Kirk here again at Option Alpha. So today on the podcast, we've got an awesome guest, a friend of mine, Mat Cashman, who is coming on to talk all things gamma and gamma exposure. We really got into it with understanding not only just what gamma is at the very basic level, but why traders should care, what should we think about, gamma exposure levels, particularly for zero DT traders. But I think what Mat does a good job of doing is just adding a lot of context to how people should think about gamma and gamma exposure and what's going on or potentially going on in the market with different market participants. Since he's a 20-year industry veteran, former market maker, he's got a wealth of information and knowledge that he kind of leans on throughout this interview and this conversation. So if you haven't heard Mat talk before, he does a really good job kind of breaking things down and adding context to it. Always a fun conversation to have him on the show. If you're listening to this audio version of the podcast, you want to go on over and just actually probably check out the YouTube version of the podcast that we have today, because there's a lot of charts, a lot of graphs. We were able to get a really cool market environment at the date that we were recording it, which was September 5th, 2025. This was just after the market opened. And so we had the jobs numbers that came out. Initially, the market was up really big, then started to actually backpedal. And so we actually could see the market playing around with some of these gamma exposure levels as we were recording live. So it was really cool. So I hope you guys enjoy this one, but let's get into the interview with Mat Cashman. Mat, what's going on, man?
Good. It's good to be here.
We already had about 20 minutes of banter, and we're just like, all right, we got to get into this. So
we used to call it on the Bloomberg chat in London. We used to call it Bantz, BANTZ. It's like someone has good Bantz. That means you can talk to him forever.
We talk about skiing, we talk about markets, talk about everything. So
Kirk has good Bantz.
you have good things to talk about. So hey, listen, I appreciate you being here. So we want to talk, kind of all things gamma today, gamma exposure. So I said at the beginning, but I'll start this way too, so everyone knows who's watching this or listening to this. I want to try to take this from the angle of like starting at the beginning, trying to understand what is gamma, what does it mean for a trader, how could we use it, how could we interpret it, maybe things that we don't, need, or like things that people say and they're like, hey, this is then you're like, you probably don't actually want to look at that, Yeah. So let's start off with this, like, what is gamma for options traders? And then why is it important for traders? If it is important for them to understand it or to watch it, I guess.
Yeah, it's a great place to start. Gamma is a measure of an option's, I consider it a measure of an option's potential to change its delta, essentially. And so when you think about gamma, I want you to think about, oftentimes I use the metaphor of like a race car versus a giant truck, right? A giant truck doesn't change direction very quickly. It doesn't move around quite as agilely. A race car moves very quickly and can change direction very fast. That's kind of like an option that has very little gamma. The big truck and the race car is the one that can change direction very quickly. That has a lot of gamma in it. Mm-hmm. One of the things that people that sometimes it gets missed in the kind of conversation is that gamma is a second derivative. It's a Greek that measures the change of another Greek. So, that's not always, it can be something that gets people a little confused. But if you think about delta as your kind of net exposure to the underlying, a delta is how much the option is going to change in value for every $1 move in the underlying. Gamma is that same $1 move. How much does the delta change of that option? So delta measures like price movement of the option. Gamma measures delta movement of the option over the same $1 move. So as you can imagine, you're going to get a lot of gamma centered around options that are at the money, because those options are going to be the ones that are most sensitive to their delta changing for that $1 move that you're talking about.
And that's because they could be quickly moving in and out of the money, and they're going to be more stock-like.
Correct. They will move from an out of the money option that has very little to do with the actual stock movement, which is a low delta option. And if you were to move the stock through that strike, you would end up with an option that has moved from like not being very relevant from a gamma and delta perspective to all of a sudden being very relevant. And that is the actual change of the state of that option from, being an inert kind of situation to being a very active situation. I think about things in real kind of like scientific metaphors.
Yeah, it's almost like heating it up, right? Like it's going to be like if it's hot, it's going to be bubbling and boiling and quickly moving, right?
Correct. Yeah.
Yeah.
To use a scientific metaphor, yes, I think that's the truth. I always also like to think about it as gamma is a measure of an option's potential energy, the ability for it to change state quickly, right? The more gamma you have, the more sensitive that option is going to be to the underlying movement because it's going to change the delta of that option for that same $1 move.
Right.
Gamma is expressed as a decimal. So you're going to see it expressed as a decimal all the time. Or, I mean, not all the time, but many times.
On the individual chains, yeah.
On individual chains and on individual options. And then it can also, right, you can also think about it as a cumulative idea when you're thinking about a much larger position. All of these options have gamma, and they are kind of like pushing and pulling on the overall gamma of the position. If you have a position that has a lot of options in it, particularly on a lot of different strikes, you're going to have a slightly more complicated gamma profile because your optionality kind of count changes as you move from one strike to another.
Sure.
And that's going to be different depending on whether you're long the at the monies and short the upside calls or the opposite of that, or, et cetera, et cetera. And so that's something that people oftentimes, and I'm sure we're going to build into this conversation, how they look at the gamma as it pertains to the market in general, right? Like, where is all the gamma, right? There's a lot of talk right now about that.
And that's what I think a lot of people are looking at too, is they're looking at, okay, because a lot of people trade 0DT. I trade 0DT or 1DT or very near term. And so they're trying to figure out, okay, how are, market makers, market participants positioned, and what can we infer from that? So
yes.
I know you did that before. So it's kind of like, now the question is, okay, how does a retail trader look at it? But then how does somebody who's, warehousing trades, to use a term, right? Like, how does a market maker look at it too? Because they might be looking at it differently. So
the market maker side of things is kind of interesting because in some ways they are, I pay attention to a lot of people who are on FinTwit and things of that nature who are in the same situation that I am in, where they used to be market makers, and particularly market makers that were running very large 0DTE books at very large Chicago market making firms. And many of them talk about it in terms of like, when you're trading that much volume, you don't really have a choice as to like how you're hedging, right? You are hedging constantly. And so you're trading so much that the book itself is just kind of hedging every time it makes an options trade. And sometimes it waits to trade options versus other option trades that come in. And sometimes you hedge your delta on a minute by minute basis. Sometimes you hedge it on a trade by trade basis. And so what you really need to think about from the market making perspective is that they are acquiring and deacquiring in some way, just position size on different strikes in different ways throughout the day, throughout the course of normal market making. But that generally speaking, they're constantly hedging their delta. There's not going to be a bunch of people who are like
trying to stay as neutral as possible. Right.
They're trying to take as much variance out of their P&L as is humanly possible. Mm-hmm. And to take variance out of an option P&L, you need to hedge it, right? You have to hedge it with to take variance out of your delta book, you have to hedge it with other delta. You can, hedge it with other delta that comes from other option trades. Or if that's not available immediately, you can temporarily hedge it with stock or with index, which would be futures in that case. And so when you're trading market maker to market, like just market maker trading, most of the time your machine is just kind of like trading the option, immediately trading in the case of the S&P, the SPOOs against it, right? The S&P futures, the minis against it. And it's just doing that constantly. So what you really need to think about, if you really want to try to glean as much information about that side of things as possible, is what really matters is the resultant kind of like residual position that you have on, not necessarily like what are they doing right now, but how much of any one strike do you have on, and how much of any one other strike do you have on against it, right? Because that's ultimately what rules what your position is as the S&P moves around to those different strikes. Your exposure changes whether you're long or short that strike.
That makes
All of a
sense.
sudden you can be, especially when you're talking about options that are zero DTE options, because those options only have however many hours left in them
Right.
if you're on that day. One thing that we didn't necessarily talk about at the beginning is that gamma, in its most general idea, is we did talk about the fact that it was most centered around at the money options, but we didn't talk about the fact that it is also most centered around options that have the least amount of time left in them. And so you could be able to extrapolate from that the idea that if you're looking for an option that has an exceptionally high gamma profile, it's going to be the at the money option that is expiring in the shortest amount of time.
Right.
So
So basically, zero DT
right.
traders, we're playing in fire. That's it.
Yeah. Well, I wouldn't say you're playing with fire. You're just playing. You need to understand that, like, you're trading all the gamma.
No, you're trading all the stuff. Yeah, it's going to move fast. Yeah.
Yeah. It's all the gamma.
Yeah. Yeah.
When I talk about it, I always talk about like these are very gamma rich options, but they have almost no vega in them. They're not going to be very sensitive to implied volatility moves.
Right, because it's just the day. Right.
Right. They're going to be real sensitive to where is the underlying at the end of the day. Right. Mm-hmm. Where are we now? And where might it be? That's the only thing that kind of matters in that case.
Well, it makes sense because that's the last thing that matters. There's no more time. Volatility doesn't really matter today, because you can't extrapolate it out. Interest rates have no impact on it, right? So
no interest rates, there's no dividends, there's no nothing. Right?
There's no nothing, right? So it's left as price, yeah. Okay, so let me share my screen. So we were chatting through this too. This is the new game exposure stuff that we have on OA. Let me just refresh it. So oh my gosh, which actually just changed. Did you see? Like it was actually totally different from before when we even started recording this. So just for people who are watching this, this is showing right now the zero DTs, which are expiring today, which is the date that we're recording this, September 5th, which is just after huge jobs and market, very anticipated jobs number. Market's up big right now, or was up big, I think. I don't know if it's still up big. But this is showing where the market current price is. And then what we have here is we have the call gamma exposure and the put gamma exposure, which has shifted actually significantly even from when we started seeing this to now we have some negative net gamma exposure across at least the profile of these 80 strikes. So here's the question. And because we were kind of going through this a little bit, but let me try to ask it this way. Like, what should a trader be looking for or be watching out for? Or like, what does this potentially tell us about who has what position or what market has what position, or any insights on like what could happen in the market for the day?
Yeah. There's a couple of things that I think are important to build in when you're looking at something like this. The first one is any assumption that you're going to make based on just like one data point or two data points is going to probably be something that's going to point you in a direction that might not be the truth here, right? So
it's got to be comprehensive. Right?
Yes. Mm-hmm. I think it's best to really point people to the idea that you want to use tools like this to build a more comprehensive kind of holistic view of what is happening. It's going to give you some ideas about like where you should look, but I don't think it's going to give you like, I always caution people against trying to like read the tea leaves of just like open interest all by itself, because
you don't know what those positions were. Yeah,
exactly. You can't know what people have against it. You can't know what, right? Like the hard part about that is that options can be hedged in many, many different ways. And so you don't know necessarily how other people have it hedged.
Yeah.
So
the good part there, and like the added thing that maybe I would add in there, you tell me if I'm right or wrong on this, but I always see people they might email in and be like, hey, there's a, 25,000 open interest at this put strike. And I'm like, well, that doesn't mean that they think the market's going down. That doesn't mean that they know it's going down. It could mean that they're hedging. It could mean that they're, that is a bet that if it goes down, but we don't know what the purpose of that was. And it could have been paired with another position. So
Exactly. One thing that I'll give you an idea to drive that point home. When I was trading the S&P, oftentimes the most bullish indicator was people buying tiny out of the money puts in size. And the reason why,
I
right? And
could
you can
totally
see,
believe that. I could totally
right?
believe that. Yeah.
You can see that as a market maker, if you were just starting, you'd be like, these people are buying like $1 puts. Like this thing is going down, right? And what was really happening is that they were buying 10 times as many futures, and
They were hedging. Yeah.
they were hedging by buying tiny little puts. And so what you end up doing is starting to like create these like second and third knock-on effects that you can actually start to like make sense of. I'm not saying that every time you see someone buy little puts, everything's going straight up. What I'm telling you is that that's one of those kind of like pitfalls of the fool's errand that sends you into, right, the
Sure.
rabbit hole that
That's
you
a
don't want to
great
be in,
example.
right?
Yeah.
Let's build a more holistic idea. So in that regard, right, to that end, let's build a more holistic idea. I think the best part here is that we have most broadly right now, especially, right, one giant customer that happens to come in and trade kind of the same thing many times over in the zero DTE space. I've heard him or them referred to as Captain Condor by many people. I don't know how you refer to this person or this what entity, whatever it is, but they trade a lot of condors, right? I mean, is that still the case? I'm guessing that's still the case.
I mean, I think that a lot of people on Option Alpha trade a lot of condors. I definitely do condors with butterflies, spreads,
Yeah.
individuals. So yeah,
And there
I
are
would assume that would be the case for zero DT, just because it's cheaper for a retail trader anyway. So
it's cheaper for a retail trader. It also gives you a much more defined outcome, right?
yeah,
It doesn't leave you open ended in any way, shape, or form.
right, yeah, 100%. Yeah,
But many times when I'm looking at things like open interest and open strikes, what I end up seeing is something similar to what I think you're seeing on this right now, which is that there's some large strike open interest or trade, volume that is out there. That's probably because there's a condor that has been traded in that way. Would you agree with that?
well, that's actually when you said that, I immediately thought, yeah, it, if I'm looking at this, I think, okay, that makes sense that these strikes are so close together, and maybe potentially a big position just got added to it. So let me
Yeah.
actually let me share a different screen here. Let me go to this one. This was actually this morning. I did happen to grab a screenshot right after the market opened. So this was actually this morning, right after the market opened, which did not have that. It looked like everyone's position, or potentially the bulk of the positions, were just a couple strikes above the market. But
Right. But I would look at that and I mean, my first reaction is like someone traded a call spread, right?
right,
Like a big call spread. And it's the whatever that is, probably the 35-40 or the 30-35.
65, yeah, 65, 35, 65, 40, something like that.
It's somewhere close to that, right? And so
Well,
in some ways,
and now
when
the
I look
question
at
is,
something
oh,
like
sorry,
this,
go ahead. Yeah.
yeah.
No, go ahead.
No, go on.
No, I was going to say, so in that
When I look at
case, so I think our connections are weird. So when I look at that, I go, okay. So now I'm trying to put myself in the seat of not only a trader myself, like trying to understand this, but then trying to like figure out, okay, like what does that mean for me as a trader? So if someone has this massive call spread, right?
Yep.
And somebody's holding this position because that trader has that position and that market maker is holding that position, right?
Yep.
What does this mean for me? Does this mean like, I'm just asking questions here, but does this mean that level now, like if the market gets to that level, the market maker might have to then hedge and sell stock, right? Or maybe they don't, or like how did, because their deltas are going to evolve as they go, right? So
absolutely. Yeah. And like I said at the beginning, their deltas are kind of constantly being hedged, right? They
sure.
don't necessarily have a choice as to whether or not they're hedging their deltas. When I was trading, we had to make that choice. We had to say like, okay, like where do we want to hedge the delta? But I think right now the volume is so concentrated in these short-term options that they don't even choose whether or not they're hedging, which actually makes the idea of what we refer to as charm something that is actually more relevant now than it probably ever has been before. Charm is delta decay. It's like how much your delta changes over time. And so if you think about the fact that maybe a market maker has a large call spread position that they've been put into, right? Let's say this call spread that we're looking at, the whatever it is, the 30-35 or the 35-40 is above the market. And so let's say someone came in and sold it, and you're a market maker and you bought, 1,000 of the expiring today call spread. Well, that has a positive delta. If you're buying it, you're going to be selling SPOOs, selling some sort of delta against that. Mm-hmm. If you are selling underlying, like futures, SPOOs against it, you have something against your call spread that does not expire at the same time your call spread does and does not decay in the same way.
Right. Yeah. 100%. I get what you're saying there. Yeah.
So what you have is upside call delta that is hedged by something that does not expire. And as that delta decays, you have the same amount of futures against something that doesn't have as much positive delta. And so you are getting what we call, I would say you're getting shorter and shorter and shorter delta over the course of time because your call spread is losing delta, but the hedge against it, which you sold short, is not losing delta. It is still the same.
And in that case, would they start then buying back some of that position and start?
Correct.
Interesting. Mm-hmm.
Well, I don't necessarily think that they're buying back necessarily the option position.
The futures position, right? Because they don't need the full exposure for the rest of the day. Yeah,
exactly. And so if you think about it, I want you to think about it in this way: if someone came in and just sold like 1 million of this call spread, and every single person who trades options was on the other side of buying that call spread, and then the person who sold the call spread did nothing else all day, right? What you would have is all these people who bought this call spread, hedged it with SPOOs, and then sat on it and waited for like the guy to come out and buy it back at the end of the day. And if the guy doesn't come back and buy it back, what ends up happening? At every hour that passes, if that call spread does not go into the money, it loses delta.
It's decaying. Yeah, right.
It's decaying. And all of these market makers who are short SPOOs against it are buying these SPOOs back. Well, what happens when you initially hedge it? When you initially hedge it, everyone has SPOOs to sell. The SPOOs probably go down.
Right.
Because everyone has SPOOs to sell against
it. A little bit.
And then guess what? As the day progresses, you get this natural drift because everyone's buying back their SPOOs over time or their underlying or whatever it is. And so what you get is this natural drift back to either the original level or potentially to the strike, which is what people oftentimes look for when they're looking at this. Now, I give you that example not as like, this is definitely going to happen every time this happens. I try to extrapolate from these situations a more kind of general idea about how the market dynamics work.
So this is great.
So when you see things like this, you can see how it might play out, right? And how those dynamics are working. That, what I just described to you, is charm at work in the actual world, right?
Just kind of evolving as it goes, because that's what it is just the evolution of it,
Correct. And that's all that all that charm is us figuring out a word to use for like, the delta of this option changed from 6 a.m. to 10 a.m., right? I mean, and so we called it charm. I don't know why, but
iron condors, iron butterflies, no one knows.
Yeah, they all have crazy names. Jade lizards, I don't even know what that is. But so that's what that is, right? And as you can see, right, this thing just changed again.
Well, I know. Now I went back to the live one, so that was like, that was when the market just opened. So, but now back to the live market, just so we can see. But so now we have this scenario where I'm like, okay, well now. I think when I did the live one, let me just go back. Market was at 60, 65.28. Now it's at 64.60. So it's obviously pulled back, right? So now it's like, okay, now I'm looking at this going, okay, this, just visually, I'm like, this looks like some potential trouble. But is this the same type of potential trouble on the put side where is this going to act as a mechanism where the market, potentially gets to this level and starts to float a little bit because now everyone has to buy back,
certainly that's a possibility as well. I think
does it just like blow through that level?
Well, we don't know, but you don't know that necessarily, but what you do know is that if the market does potentially get to that level, that theoretically, if all other things stay the same and things don't change markedly, the market maker position and their resultant gamma and theta positions are going to change if we get closer to that strike. We know that for sure, right? And that's something that you can just look at by saying, okay, there is an imbalance between buyers and sellers of some sort on these two strikes, right? I mean, that we can extrapolate from the most general and say that there is something going on here. What I like to do when people show me these things is to look at it and say, like, I don't know exactly what's going to happen when we get down there, but your ears might want to perk up when things start to get to that level, because that means if that situation is staying the way that it is and the futures go down to that level, there are going to be some things that are changing on some very big desks, and there might be some hedging that is going to be more dynamic at that level than it would be at any other level in the futures.
Right. So the idea would be it's generally going to be, or could be, we still don't know, right? Like anything could happen, right? But
sure,
if there's not much happening around the strikes that's currently at, there's no reason for any of the other participants, regular traders included, to do anything, right? That's really the idea. And it's not until they get to these points where it's like, well, okay, now poop or get off the pot. Like something's got to happen. And in the case of, it would it be right to say in the case of like a market maker at this point, if there's super, super negative gamma exposure at this point, they might have to buy back stock to hedge their negative position.
If they are negative gamma?
Yeah, like if they have negative delta exposure here.
If they have negative delta, yes, they would be buying SPOOs, buying underlying as it goes down, right? To hedge.
Right.
But the other side of that is if they have negative gamma, remember what we said about gamma, right? Gamma is the net change of the delta over that $1 move. Negative gamma makes people longer delta as you go down and shorter delta as you go up. So that's an interesting like byproduct of that situation that creates what people call convexity, right? Which means that people who are naturally negative gamma have more futures to sell the lower something goes, right?
So now it just becomes like a self-reinforcing process at some point.
Correct. And that's what, when you hear all these talking heads talking about, this exact situation, what they're talking about is trying to figure out at some point the inflection point where people don't just where it becomes like buy the dip is great right up until the point that it's not. Everyone's waiting for that kind of thing to occur. And many people that are options centric are out there saying that these kinds of flows might be the thing that creates a situation where like everyone buys the dip and then all of a sudden the people who actually have to hedge their negative gamma on the downside come in and start selling and there's no one left to buy, right? Like that's where people are like, oh, that could get real bad. Well, of course it could get real bad.
And that's why if you generally see, would it be right to say that's why when you see things, if you're just happen to be watching the charts, right, and you see like a break and then it just runs, that's why it's running. Because it's just like a cascading effect of just, needing to sell in order to hedge and needing to sell again in order to hedge, et cetera.
Yeah. I mean, that's definitely one reason why it can happen. I'm not going to tell you every time you see something like move like that is what's
not
happening.
Every time, but that could be a reason why it breaks so hard. Like people always say like, oh, it just breaks and just snaps, right? And it's like, well, it probably snaps because maybe, a lot of hedging needed to occur, a lot of hedging. Yeah.
And as you can imagine, I mean, that's part of the reason why when we started talking about zero DTE volume rotation, that there were so many people that were like, this is a systemic risk, right? Because of this very thing. You're dealing with something that is a very gamma rich, the profile of these options is very gamma centric.
Interesting. Yeah.
For anyone who has traded through something like 2008, that's the first thing that they think about is
or even flash crash, or even flash crash,
or even the flash crash. Yeah, I mean, they were actually in this case, the flash crash is probably a better example of that because there wasn't as much. 2008 was something where it was just like volatility all over the place.
Yeah, it was just like prolonged.
Yeah, complete I call it the goat rodeo, right? It was a goat rodeo in 2008. Flash crash was something much more like this,
I
where it was
happened to be
like,
watching it that day. That was a time before bots. That was BC. So
yeah,
before we had those. So,
BB
but
for
huh?
bots,
Yeah, that was
BB
before
before
those,
bots.
right? But I actually happened to be watching it, and I remember vividly going, "What is happening?" And I was like, like, did a nuclear bomb go off? Like, whatever." And then it just
Yeah,
like went down, and I was like, "Oh my gosh, I don't know what's going on." And then it went right back up. It was
yep,
crazy. It was a crazy time.
yeah,
But so
and that,
even while we've been
you know,
talking, look at this thing just starting to
yeah.
grow and grow and grow. So what is that? I guess now it's like this is very interesting because we're just doing this as we go. But this is just becoming bigger and bigger and bigger. So does that mean this is going to be a massive inflection point, essentially?
I think what it means from my perspective is like if the futures get down there, things are going to get real interesting for lots of different reasons. Right now, what this may mean is that the original person who put this put spread on is selling more put spreads
Just
into the move down, right? I
right.
mean, it's just like sold, 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 sold. Or as a market maker, sometimes what you run into is there's a giant order in a put spread that's like, I want to sell 25,000 of these at 4, right? And it's just like sitting there. It's at 4 and the futures keep ticking down and you're looking at it, you're waiting, and then your machine goes off and it's like ding 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 ding, ding. It trades 4 over and over and over and over and over and over again, and people are buying it and then buying futures against it and buying futures against it, and then it goes back up, right? And then the put spread stops trading for 4 because it's not worth 4 anymore.
Right.
And then it sits there and then maybe it does it again, right? The futures come down and the thing ding, 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 it trades 4 again. Maybe this time the futures are actually a little lower because people have lowered their implied vols on it or whatever. But that's the way that kind of thing might be transpiring in the marketplace. I'm not looking at the flow immediately, so I can't exactly
Right.
tell, but that might be
Well, but
something.
that's a good thing is like that's a great point is that could be just a massive block that has or series of blocks that have come in.
Sure.
You know?
Absolutely.
Yeah.
That's definitely possible. And it's plausible. That's the way that people
Sure.
oftentimes trade, right? They'll be like, I bought this put spread for 1 and I want to sell it for 4. And I don't care where the futures are because I'm making, $3. I
Mm.
mean, people who are on the retail side know very acutely how that works, right? They
Yep.
do that an awful lot.
Well,
Uh,
that's a good point too. It's just like adding into all of this as part of that whole thing that you were talking about is like it's not one data point, but it's like building this, collage or this whole framework and but adding that rational side of like why would somebody rationally be doing this? Like, does it make sense that somebody would do this? Well, yeah, of course. It would make sense that somebody would buy and put, or sell a put spread or do something like that, below the market in a big way, especially
yes.
on a day like today where market opens up higher and is coming down. I just brought up the 1 minute chart of the S&P.
Yeah.
But it makes sense that maybe somebody says, well, hey, look, we kind of reversed the whole open already by the time we started talking. So now maybe I, buy the dip here. So
Yeah, well, and if you think about the idea of the whole like buy the dip mentality, many people try to use options, particularly in the 0 DTE space, to
right.
actually approximate delta trading by doing things like, if you want to approximate a long delta exposure, meaning you're long the underlying market, when the market is going down, there's very few other better ways to do that than by selling put spreads or selling puts.
Right. Right.
It's right. It's a very natural kind of thing that people just use those, especially people who are trading it speculatively,
Mhm.
use those structures in that way. So don't be surprised when you see that, and don't necessarily think that it's like, don't try to read too many tea leaves when you're seeing something that it could be someone who's just like, I want to sell the put spread for 4, like
Right.
whatever.
I just want to do it. Yeah.
Yeah. And
Makes
so
sense.
that can be difficult. But what I would say is when you start to see these large blocks and start to see accumulated positions, like I said before, it should be a situation in which it just makes your ears kind of perk up a little bit, right? And this is a way that you can draw your attention and be able to maybe separate some of the signal from the noise, right? Because there's an awful lot of noise
Right.
That's thing that we all know is true. If you try to watch the entire tape all the time,
So you can't do it. It's possible.
you can't do it. It's impossible. And
Yeah.
so that's part of, I think, what tools like this are good for is they are able to like help you kind of zero in on
That's all
certain
we're trying to do
areas.
too.
Yeah.
Right. Yeah. We're just trying to give you data points and trying to, understand. So, all right. So while we watch that unfold, so it's basically right at that level right now, by the way. But, anyways, here's one that I saved a couple days ago. I saw this one in preparation, knowing that I would talk to you. This was back on September 2nd. I think it was about 8:40 in the morning. So, like 10 minutes after the market opened.
Okay.
But this was another one where it's like, okay, that's kind of scattered. And it's not on one strike like we just saw or a
Yeah.
series of strikes. So if you see something like this, does that give you a different perspective on something? Or because it's more broad based, it doesn't feel like it? And this is just me asking, like I'm trying to, figure it out and interpret it myself too. It's like, okay, if it's not one strike, we rule out the one trade, one block thing.
Yeah.
It seems more broad based. So does this feel like, hey, there's a lot of downside exposure here, or just a lot of volatility exposure here? Things are all over the place, or not, or you're just like, no, Kirk, that's all crazy.
Well, I think there's two things here. Number one is what you just said, which is that there's no like immediate and obvious structure that is like, oh, someone traded a call spread or someone traded a put spread, right? You see all of those bars as just like, they're just down here and it's kind of like a big variance like swap that's going on here. And what I think when I see something like this is either I think it's probably big enough notionally that it's not just like market makers trading with market makers, because they're not going to do that in that kind of size, right? The last thing that market makers really want to do is like cross paths with other market makers unless they have to. What you really want as a market maker is to be trading with customers. The reason why is because customers are people who generally come in, put something on, and then come back in and take it off, right? You want that kind of flow.
Yeah.
And so I don't think this is market makers trading with market makers, right? Every once in a while, right, you would cross up with another market maker, like on the open, two people have differing opinions about what the straddle should be, and someone's like, I'm 30 bid, and the other guy's like, I'm at 30, and then like 500 of them trade. That's not what this is, right? This is some amount of chatter going on in options broadly across the board and changing hands to what I assume, Kirk, correct me if I'm wrong, but when you see that GEX ratio negative up there, what you're actually seeing is the dealer exposure being negative gamma. Is that correct?
Yep. Yep.
Yeah. Okay. So you can assume
multiples. Yeah.
Yeah, you can assume kind of someone came in and bought a lot of options, right? And maybe they bought a lot of options across the board, and dealers are relatively negative gamma in that
environment
part of the curve, right? Mm-hmm. The very short dated 0-day option. Now, it is possible that someone came in and traded a, 0-day, 4-day at the money straddle swap, right? And what they ended up doing was selling that straddle swap, meaning they sold the 4-day straddle and they bought the 0-day straddle, and you're only seeing one side of that trade, right? That's possible also. Yep. We're just looking at the 0-day option.
Yep. That's
so it's important to think about it in that way too. And that's part of what I try to, drive home also, is that we're dealing with all this granularity that's like you have to keep track of.
Right. So, but even in this case, it's like, hey, there's a lot of stuff going on here.
Yeah.
It's probably going to move a lot, essentially. Like,
well, it just means
a lot of movement.
You would expect, let's say, I always hate to say movement.
Not like a lot, but not like a 10 basis point day.
What I would expect in this case is that people who are trading this from the market maker side are going to be more sensitive to movement than they would on any other like normal day, right?
That's true.
And so that's the way that I interpret it, that like you might get into a situation where a move that would otherwise be 1 standard deviation ends up being like 1.5 or 2 standard deviations because of the resultant convexity hedging that's going on, right? If everyone's short all the options that are on the 0-day spectrum, you're going to get some like weird dynamic hedging situations when things move. And that's what turns one SD moves into two SD moves, right? Like that's how it works.
Yeah, that's true. That's a good point. So, well,
So
since you brought it up, so is it more value? Like, how do you, as traders, as like a retail trader, especially if you're a zero DT or short DT trader, what other strikes are you looking at or other expiration periods are you looking at if you're looking at anything? Like if you're trying to build this model or this framework across many, like even what you said, we don't know if it's some sort of position that's a straddle across the 4 and the 7, or
yeah,
the 4 and the 0. So are you going out to those and saying, okay, like going through those, is anything, kind of like, stand out? Do you go too far out? Like how should somebody think about that?
I think it's something where, so number one, I don't want people to feel the need to like build some.
Psychoanalyze five
Yeah, so,
positions.
well, some giant. I was talking to. I went to University of Chicago yesterday for an event, and I was talking to a bunch of, they're kids. They're like 19-year-old kids who are studying financial mathematics, and my point to them was like essentially what I said before. The signal noise ratio is like through the roof to the noise side, and so oftentimes if you get sucked into the rabbit hole of this whole thing, you can get really sucked in and it can be more noise than it's worth. I would say if you are, from a market making book, if you're trading every contract on the board, you got to keep track of this, right? You have to know where the real open interest bombs are and where your result. And generally speaking, you don't even, if you're trading it from a market making perspective, you don't need to like have a program like this to tell you where the bombs are because your position tells you where the bombs are, right?
Right.
If you're making markets in it, you know that the guy sold 50,000 call spreads on the 4-day, like upside call. But I think if you're trading everything, you have to be aware of all of those things. If you're trading it from like a more retail and very kind of acute perspective, I think it's perfectly okay to just be like focused on like, well, this is my position and this is the only thing I really care about, right?
It makes sense. Yeah, that's a good point. Yeah, because if you don't really care about anything else and you have let's even say a defined risk position or an iron condor position, you don't need to be monitoring what is happening in the 80 strikes across the next 10 days.
No, I don't think so. But I like that it's possible to do that with this tool.
Right.
I think it's, I think you need to recognize that as we have gotten more granular ability to hedge, what we have done is also gotten a way to like interconnect all of those days. Mm-hmm. And so if someone comes in and buys everything in the 4-day option, you can imagine that the 4-day option, the 5-day option, and the 3-day option are all going to probably do this, right? They're all going to go up. And conversely, if the opposite happens and someone sells everything on the 4-day option, the 3-day and the 5-day option are probably also going to do that. But what you need to also recognize is that the reality of that situation is that people like to hedge optionality with optionality that most closely approximates the optionality that they just bought or sold. And so you're going to see the strongest kind of like connection with the days that are immediately around it. Right. As a market maker, I don't really want to hedge 2-day exposure with 10-day exposure. It doesn't really do me any good. If I have to, I'll go out to like the 10-day exposure because there's nothing else I can do. But if I'm short a bunch of 2-day options, right, the best thing for me to hedge with from a market maker perspective is the 1-day and the 3-day options, right? Or
makes sense.
The 2-day options, right? I mean, like that's all I care about.
Yeah.
So you'll see the curves like that move, right? Especially implied vol wise and just strike wise and, things of that nature. But what market makers are going to reach for first and foremost are the things that are most closely approximate the risk profiles of the thing that they just traded.
Right. Of course.
That's what they care about.
You don't want to hedge bananas with apples.
Yes.
You can hedge apples with apples. Right. Yeah.
Exactly. Yeah. Unless you have to, right? Unless you have to. And if you have to, then like you'll take what you can get and roll the dice, right?
You'll take the Granny Smith apples because no one likes those. Let's be honest.
No one likes those. They're kind of tart. And like, why would you do that? Why would I want to bite into that? If I wanted to, If I wanted to eat a lemon, I could just eat a lemon.
That's what I always say. My wife keeps buying them for the kids. I was like, can we please get some Golden Delicious in here? I mean, like the name says it all. So
Exactly.
awesome, man. So it actually looked like, just real quick for those of you who are following along, I know I'm going to get comments. People are like, you didn't see what was happening in the market at that time. So just a recap before we wrap up here. So the market is getting more volatile around that period. So it's exactly what's happening. It's kind of bouncing, but it's definitely moving a lot more. It's becoming more of the inflection zone that you were talking about, which I think is fascinating, because if you had watched this progression,
Yep.
even today, like just as we were talking through this, if you were on the minute chart, you could probably see where the inflection point was going to be, and that may have been, I think, maybe a little bit of an edge as if you're a trader, is like, okay, maybe I just wait till this inflection point first and then do something. So I think that's pretty, at least
Yeah.
enough. So,
Well, and oftentimes from a trading perspective, really quickly, one thing that I like to always point out is that these kinds of scenarios build very short-term memory into the market that you're trading. The market remembers, right? In some ways, the levels that traded. And for instance, that this looks as though what actually happened is what we were talking about, that someone may have just at the bottom sold a bunch of put spreads at like 4 or something. And everyone who was an options trader bought all of those and then bought SPOOs with it. And then guess what? The SPOOs kind of like come back up and then they like kind of fizzle out and it goes, maybe we might be going back down and
we are.
the put spread may trade again.
Yep.
But what it does is it creates tiny little bits of memory. Yeah, see, here we are, right? Tiny little bits of memory where people remember, like, okay, there was a bunch of put spreads that traded here last time. Right. Yeah, exactly.
Right. Yeah. That's what I think is fascinating about it personally. It's just like that memory side that you say there. It's so true, because I think people even say it. Like you'll see comments and people say like, "Oh, every time it gets down to this level, like whatever." And it's there's more dynamics happening behind the scenes. So awesome, man. So what do we miss here? What do we miss about Gamma? I know we talked a lot about stuff, but like in your opinion, you walk away from this, somebody's watching this. What are we missing from this conversation? Like, I don't know, as a trader, like I feel like I'll say this and you can tell me if I'm onto something or not, but then please add your own. I think Gamma is something to pay attention to. I think it's like everything. Like you should know if it's sunny or raining outside, but you shouldn't stare at the sun all day. Like you don't need to stare at the sun all day, like, but you should have an awareness of it. And that's how I kind of think about it. It's like there's an awareness factor, but there's not a focus factor. I don't know if that makes sense, but
no, I love that. I actually really like that as a characterization of how you should approach this. And in service of the holistic idea that we've been talking about, I think that's a really good way to frame it. To think about, I want to know when I should be paying more attention than when I don't need to pay attention at all. And sometimes these kinds of tools can help you to do that. From a Gamma perspective, I want people to think about the likelihood of the large players that are moving things around, the likelihood of them to trade futures at any one point in time is kind of material. It matters. Now, you're not going to be able to like fully predict when that happens. But what this does is it gives you a way to know when you should be paying attention to looking for the signs of something like that transpiring in front of you. I think that Gamma most broadly is something that people should pay attention to most specifically in their own positions, right? Like, let's talk about that if you're really looking for how Gamma is going to affect your P&L, most specifically, it's going to be, what is your Gamma right now, right? Like trying to zoom out and look at everyone's Gamma across the entire world or entire options ecosystem is a thing that you can do, but it's going to have less of an effect on your personal P&L than you being able to manage your own Gamma of the position that you're trading in front of you. I think that's the first place people should start. Like, what's my Gamma? What's my plan to trade this Gamma? And then like you can start to zoom out from there and start to think about it more in a much more holistic way as to like, when do I want to put these positions on? When do I not want to be involved, right? Those kinds of decisions can come from a more holistic approach but I want you to consider your own position primarily,
Right.
and then the broader position of the marketplace in a secondary way.
Awesome. Well, we might have to get you back on here and we'll talk more about individual position portfolio gamma. So as a follow up to this, but Matt, awesome, man. Thank you so much. Where can everyone find you, connect with you? I know you do so many of these things.
I do a lot of them, but this one was particularly fun. I write a lot on LinkedIn and X. You can find me in both places there. My name, Mat Cashman. And then you can also find an entire host of educational resources at optionseducation.org, which is where the OIC, the organization that I work for, the Options Industry Council, hosts all of their educational resources. So you can go there and check out. It's a huge suite of tools and resources, and it's a great place to learn. So check that out.
I appreciate it. Thanks so much for coming on, and we'll catch you on the next one.
Right on.
All right. So again, thanks so much for joining the podcast this week. If you enjoyed this one with Mat Cashman, please let us know. Give us a thumbs up, a rating, a review, subscribe anywhere you listen to or watch or follow the podcast. You can also touch base with Matt over on the podcast page we'll link to in the show notes, so you can reach out to him on LinkedIn or Twitter, and also follow everything that the OCC and OIC is doing for options education. As always, if you need anything else, let us know. And until next time, happy trading.